Hello, my name is Nicole, and this video is a little different from the previous videos I've done. I thought I would pull up UnitedHealth Group since the stock was active today and show you what I look at when I'm analyzing whether or not to enter into a stock position. This is definitely not investment advice. I'm just showing you what I look at when analyzing these scenarios. So for those of you who are not aware, UnitedHealth Group did report second quarter earnings for 2025 this morning, and the earnings were less than stellar. The company reported Q2 2025 earnings of $3.74 per share with adjusted earnings of $4.08 per share. Net income fell 19% to $3.4 billion in the second quarter. And the 2025 guidance was below expectations. Adjusted earnings guidance was $16 per share, which was well below Wall Street's expectation of $20.91 per share. And the company is facing some challenges. One of the bigger challenges is higher medical costs in their Medicare Advantage plans, which is affecting the broader insurance industry. And shares reflected the disappointment. They closed more than 7% lower today. And the CEO, Stephen Hemsley, stated that the company has embarked on a rigorous path back to being a high-performing company, and they expect to return to earnings growth in 2026. So the bottom line is UnitedHealth's Q2 results were mixed. They met revenue expectations but missed on profitability. And the disappointing 2025 guidance, significantly below analyst expectations, reflects ongoing challenges in the industry, particularly in Medicare Advantage. But despite the near-term headwinds, analysts maintain optimistic long-term views, and the company expects to return to growth in 2026. So this might be a longer-term turnaround story. So let's hop into the ThinkOrSwim trading platform here and just take a look at the chart for UnitedHealth. I have a one-year daily chart pulled up here, and you can see that the stock sold off dramatically in April and has been kind of bouncing around the bottom of its trading range for the year in recent months. And when we zoom out to a 10-year weekly chart, we can see just how dramatic that selling was. The stock is well over 50% off from its most recent highs. And we can see here that the lows made in the worst of the March 2020 sell-off were close to $200. And that might be the next support for the stock, unless it finds support around this area. So let's take a look at the options chains to see what options are telling us about this company. First, I'd like to take a look at the implied volatilities for the different expirations, and nothing really sticks out to me. I'm going to open up the September 19th, 2025 expiry. Those options expire in 52 days, and that marks kind of the calendar quarter for the year. So it's usually a big expiry. I'm going to highlight the implied volatility for both the calls and the puts just to see what the fixed strike implied volatilities look like. And on the call side, there's something interesting here. Implied volatility is actually going up as the strike price goes up. And of course, it is also going up on the put side as the strike price goes down, as one would expect. But the call side is a little unusual. Now I'm going to open up the product depth function in the software so that we can take a look at call skew. And I want to isolate that September 19th, 2025 expiration cycle. I'm having a little bit of problems with the software here. There we go, September 19th, 25. And we can see here that the x-axis shows the strike price, and it ascends the further right you go. And the y-axis shows implied volatility. And implied volatility goes down until we hit that 240 strike price roughly. And then it goes up as the strike price goes up. So once again, that's a little bit of an unusual shape. It shows that there's a lot of juice in those call options. Let's bring up SPY for comparison, and we're going to bring up the same expiration cycle so you can see what that curve looks like. And you can see the curve looks much different. Implied volatility goes down until it kind of bottoms out around the 690 strike and then just kind of bounces around the bottom. And that's more typical for equities during calm markets. And just bringing up the implied volatility for SPY for comparison, you can see that implied volatility goes down as the strike price goes up, which is the normal order of things during call times. And for the puts, the implied volatility goes up as the strike price goes down. And again, that is typical. That's called negative skew. Now we're going to head into the tastytrade platform here to analyze potential trades. And what I want to look at is taking advantage of this call skew to look at buying 100 shares of UnitedHealth and collaring the position by selling a 340 strike call and buying a 220 strike put. This would give me a max profit of 77.20 and a max loss of 42.80. So that is attractive because that is asymmetry. I stand to gain more than I potentially lose on the trade. And this just demonstrates what I just described in the profit and loss diagram at expiration. So that's what it looks like to take advantage of call skew. And if that was too much risk, I can always move those strikes in and I can sell the 290 strike call and purchase the 240 strike put. And there we see a little bit more symmetry. However, I do stand to make a little bit more than I could potentially lose. But for those that are a little more risk averse, that could be a potential way to enter into a trade like this with a stock that is falling with a little bit of risk control. So I don't know. Do you think this is a good trade? Do you not think it's a good trade? Let me know your thoughts in the comments below. I just thought I'd show it to you because I thought it was interesting and it demonstrated what you can do when you notice unusual implied volatility in options with stocks that are moving like this. So as always, thanks for listening, and I'll look forward to reading your comments in the comments section. Have a good one.